Hey there, Mindful Finance family. You know how some games are super hard to understand? Well, today we are making the money game easy for you. You know how a biryani has layers of flavors like spices and ingredients that come together to create something amazing? Well, that's exactly what India's GDP is like. It's a mix of various sectors agriculture, manufacturing, services, all blending together to give us an economic dish that whole world wants a taste of. Okay, friends, let's talk straight. You know, when you go to the doctor and they check your heartbeat and blood pressure, well, GDP and these other big numbers are kind of like that. But for the whole country, it's like the country's health report card. And guess who's looking at it? Yep, the big bosses and leaders. They use these numbers to figure out if our country is healthy, like a champ, or needs to get better. So today, let's get into this, and we are not just talking about GDP, we are also going to chat about other big things like how equal people are, how many can read and write, and even money from other countries. And just a disclaimer, if you find money talk boring, no worries, this video might not be for you. But if you want to be the money genius among your friends, you gotta stay. So, want to be the smart cookie at parties when people talk about money and jobs? Then don't go anywhere. Stay tuned. And this is Sundar, and you are watching Mindful Finance. Alright, let's kick things off by understanding what GDP actually is. GDP stands for Gross Domestic Product. Think of it like the total income of a country. It's the sum of all the goods and services produced within a country's border over a specific time period, usually a year. So, why is this number so important? And why everybody is talking about this thing? Well, GDP gives us a snapshot of the size and health of a country's economy. A growing GDP usually means more jobs, better income, and generally a stronger economy. On the flip side, if GDP is shrinking, it could be a sign of economic trouble. Now, there are three main ways to calculate GDP, and each gives us a slightly different perspective. So, let's break them down. The first one, the production or output approach. It sums up the value added to goods and services at each stage of production. So if you are making a shirt, you would add up the cost of the fabric, the stitching, and so on. The second one, the income approach, which adds up all the incomes earned by individuals and businesses in the country. That includes wages, interest, rent, and profits. It's like looking at the country's total like a paycheck. Lastly, the expenditure approach sums up all the spending happening in the country. So this includes what people are buying, what the government is spending, and what businesses are investing. Yeah. The formula for GDP is C plus I plus G plus X minus M, where C is consumption and I is investment, G is government spending, X is for exports and M is for imports. When you use this formula, you will be able to understand the GDP value from the expenditure approach. So whether you are looking at how much is being produced, how much people are earning, or how much is being spent, all these approaches should give you the same GDP number. It's like looking at a diamond from different angles to understand its true value. Now that we have got a good grip on what GDP is, let's talk about its close relative, which is GDP per capita. It's a very important one to note. If GDP is like the total income of a country, then GDP per capita is like the average income per person. The formula for GDP per capita is very simple. You take the GDP and divide it by the total population of the country. Why should we care about this number? Well, GDP per capita gives us an idea of the average standard of living in a country. A higher GDP per capita usually means better access to healthcare, education, and other public services. It's a quick way to gauge how well of the average person is in a country. For example, if you hear that a country has a high GDP but a low GDP per capita, it could mean that the country is rich but the wealth is not evenly distributed among its people. On the other hand, a country with a lower GDP but higher GDP per capita might indicate a more equitable distribution of wealth. So it doesn't mean that GDP is less means it's a bad country. You have to look at for GDP per capita. In nutshell, while GDP gives us a big picture of an economy, GDP per capita zooms in to show us how this translates to the individual level. It's like comparing the total score of a cricket team to the average score per player. Alright, for those of you who love analogies, this is for you. You ever wondered how GDP and GDP per capita relate to business terms we often hear, like turnover and profit? So let's break it down. So think of GDP like the turnover of a country. Turnover is the total revenue a company makes, right? So similarly, GDP is the total value of goods and services a country produces. Both gives us an idea of the size and scale of economic activity. Now, what about GDP per capita? You can think of it like profit per person in a company. Profit is what's left after all the expenses are paid, and it's a measure of how efficiently a business is running. Similarly, GDP per capita gives us an idea of how well off the average person is in a country. So just like a business needs to look at both turnover and profit to get a full picture, a country should look at both GDP and GDP per capita. A high turnover doesn't always mean high profit, right? So likewise, a high GDP doesn't always mean a high GDP per capita. So whether you are looking at a country's economy or company's performance, it's important to look at both the size and the efficiency to really understand what's going on. Similarly, if you are a trader, you can relate easily. In a year, when you are going to file your income tax, you can relate easily. If you are doing futures and options, at the end of the year, your turnover might be in crores. But if you check the profit, some people may end up in negative, some people may have a good profit, some may be in average. That's what I try to compare GDP and GDP per capita. Now, hope you would understand this in clear. All right. Now that we have got a good understanding of GDP and GDP per capita, let's talk about how these two are connected. You would think that if a state has a high GDP, it should also have a high GDP per capita, right? Well, mostly yes, but there are some interesting exceptions. So generally speaking, states with higher GDP do tend to have higher GDP per capita. This makes sense, right? A booming economy usually means there's more wealth to go around, leading to a higher average income per person. But here's where it gets interesting. There are some states like Gujarat and Maharashtra that have a high GDP but a relatively lower GDP per capita. What's going on here? Well, it could mean that the wealth in these states is not evenly distributed. Maybe a few industries or cities are doing really well, but not everyone is benefiting. So while GDP gives us a broad view of the economic size, GDP per capita helps us understand how this wealth translates to the average person. It's like knowing a movie's total box office earnings and also its earnings per screen to get the full picture. Okay, so we learned that what GDP and GDP per capita are and how they are calculated. Now let's get into the fun part. How to actually interpret this data, especially when it comes to different states in India. First off, overall trends. Is the GDP per capita going up or down? This can give you a quick idea of whether the economy is growing or not. For India, the trend has generally been on the rise, which is a good sign, and there is nothing wrong in that. Our India is, since from 1990s, it's growing. Next, how does one state compare to another? This can tell you which states are doing well and which need to catch up. For example, Sikkim and Andaman and Nicobar Islands have the highest GDP per capita in India. That means these regions are doing something right. We need to find out what they are doing right. I don't have the data, but we can explore that part. We can also compare a state's GDP per capita to the national average. States like Delhi, Maharashtra, and Karnataka are above the national average, suggesting they are economically stronger than our country in a whole. Okay. On the flip side, states like Bihar and Jharkhand have the lowest GDP per capita, indicating they have some catching up to do. And then there are states like Uttar Pradesh, West Bengal, and Assam, which are below the national average, suggesting they are not doing as well economically. So it's not a political thing. We just need to understand the macroeconomics of our country, just to understand which state is doing good and bad, so that we can plan accordingly to find a good company to invest, or even if you're looking for a real estate, then you can find out where to invest your money. So by looking at GDP per capita data, we can get a pretty good idea of the economic well-being of different states. But remember, this is just one piece of the puzzle. There are other factors like income inequality and access to service that also play a big role. So we talked a lot about GDP and GDP per capita, but let's not forget these are just numbers that don't capture the full story of how people are actually living. So what else should we be looking at? First up, income inequality. A country could have a high GDP per capita, but if all that wealth is concentrated in the hands of a few, then average person might not be doing so well. In India, income inequality is a real issue that we need to address. The next one is the poverty rates. Even if a state has a high GDP, it doesn't mean much if a large portion of its population is living in poverty. So it's crucial to look at poverty rates alongside GDP and GDP per capita to get a more complete picture. So last but not least, access to basic services like healthcare, education, and clean water. These are fundamental to the quality of life and often don't get captured in GDP figures. For example, Kerala may not top in the charts in GDP, but it does really well in terms of healthcare and education. So while GDP and GDP per capita are useful for getting a quick snapshot of economic health, they don't tell us everything. To really understand the well-being of state or country, we need to look at a range of factors from income and poverty to basic services. So you ever wondered how we measure the health of an economy? So we look into GDP per capita, and now let's look into some indicators for more details. The first one is HDI, which is Human Development Index, or it's like a report card for a country looking at life expectancy, education, and income. So check this out. This table, if you see over here, which is HDI from 2013 to 2022, as you can see, India's HDI has been mostly on the rise, which is a good sign. But we did see a dip in 21, so there's a lot of room to improvement. And if you see the another dangerous thing is, it used to keep on rise, but you can see slightly there is a dip now in the current scenario. It is flat for a while. So this is also not a good sign as of now. So let's see. Second one is called Gini coefficient. So this number tells us how equally income is distributed among people. So this coefficient is something like, if it is lower, it is better. If you see the table of Gini coefficient from 2013 to 2022, notice the drop until 2021. That's a good news, but 2022 saw a jump, meaning income inequalities increase, which is a very dangerous sign. The third one is education is key, right? So the literacy rates shows as the percentage of people who can read and write. So this is not it doesn't show the degree or something like that, but it's just, this ratio just thinks about read and write. So if you see the table, it's a good news. More people are getting educated, but we saw a small dip again in 2022. So this is the current scenario. So we need to be very careful about this particular area. And the fourth one is jobs. The unemployment rate shows us the percentage of who are jobless but are looking for work. So this table, if you see the unemployment table here from 2013 to 2012, Overall, the rate has been decreasing, which is a great and good sign. But hey, we still got work to do. And inflation rate. You ever noticed how the price of stuff keeps going up? That inflation for you. Also, I made a very specific video on the inflation. Please, I'll give a link over here. Go back and check what is this inflation. Just given, I have covered a detail about inflation. So this table, if you see the inflation table from 2013 to 22, but normally like lower inflation is generally better, and we have had some ups and downs here. But keep an eye. The current scenario is very worst because our inflation is very high. Unless until our inflation is not reducing, it's not only in India, it's across the globe. We are facing this inflation problem. Fingers crossed. But this is the time that you need to find a better investment options. Now, what we are going to talk about is trade balance. So, trade balance is all about export and import. If it is a positive, means we are selling more to other countries than we are buying. But if you see the table, the trade balance from 13 to 22, it's all on negative. The problem is, it seems our import rate is keep on increasing, which is a bit thing to notice. Whether this import is good sign, but whatever the rate we are importing, similar way our export has to be double or triple. That we need to check. So we need to be very careful whether this matches with our export detail as well. The next point is about foreign direct investment, which is FDI. FDI is when companies from other countries invest over here. Normally, FDI increases their investment in India from very long time, but only time we can see the dip over here are during the time of 2008 and again similar during the Russian war. These are two times we can see they withdrawn a lot of money from us, and again they slowly increasing their investments. Fingers crossed, in the future may again follow the trend. Hi again, Mindful Finance family. We have covered a lot today, right? From GDP to literacy rates. We have taken a mindful walk through India's economic landscapes. So, okay, for investors, let's take a deep breath. Inhale, exhale. Now think of investing like planting a seed. You don't just throw it and walk away. You water it, give it sunlight, and wait patiently. The same goes for your investments. In a shaky market, mindfulness is your best friend. Be aware, be patient, and make decisions with a calm mind. The great Warren Buffett says, price is what you pay, value is what you get. So look for those hidden gems, simple, undervalued companies that offer real value. Think of it as finding a diamond in the rough. Markets are like the weather, sometimes sunny, sometimes rainy, but remember, every weather has its purpose. Rain might seem gloomy, but it's essential for growth. So in tough times, stay rooted. Don't let the storm shake you. Here's a mindful tip from Mindful Finance. When the market is down, think of it as a season of planting. It's your chance to invest wisely at lowest prices. And when the market rises again, you'll enjoy the harvest. So keep your cool, diversify your portfolio, and stay committed for the long run. We are not just for a short term, we are here going to be for a longer run. We are not running a 100-meter dash, we are running a marathon. Whatever we are going to have, this will be given to our next generations, your kids, your grandsons. They are going to get these investments, they are going to reap the benefits. So to wrap up, if you found this journey helpful, please hit the like button and subscribe for more mindful insights into personal finance. Until next time, stay mindful, stay invested.